razzle dazzle today.
It's
Got some pizzazz.
Thank you.
This is the Hamptons look.
This is woke up at 5 for a flight from Atlanta.
Oh my God.
Didn't have time to, put full product in. Haven't had a haircut in a little while. A lot of things going on.
Lots of things. You look great, Sam, still.
Oh, thank you. You look pretty good yourself, Austin.
Thank you. I need to hear that like once a week to feel normal. So I appreciate
we record once a week.
Yeah, no, let's just say you can count on it once a week.
Yes.
This is Topline.
This month's sponsor is Closed, the industry leader in win-loss analysis. The only thing worse than missing quota is not knowing why. Win-loss analysis with Closed provides detailed and unbiased feedback directly from your buyers. So when you're looking for answers, you'll have the concrete data-driven solutions you need to make the strategic decisions with confidence. If you're curious about how win-loss analysis can boost your win rate, give Closed a try. We'll do a free buyer interview for one of your deals. Visit freebuyerinterview.com now to claim your free interview. That's freebuyerinterview.com now to claim your free interview.
We have a really freaking great show on tap.
We have an incredible guest. He's in the waiting room. I'm going to bring him in. Is everybody ready to bring him in?
Yeah, of course.
Let's do it.
Let's do it.
Peter.
Can you hear us?
Steve, what's going on?
How are you?
Doing great. How are you all?
We're doing great. Thanks for joining us on Last Minute. I don't have a professional bio for you, so I'm going to say Peter Walker.
Barely professional, so that doesn't really work.
He understands the tone very clearly.
Well, Peter, I was walking by my head of content, and we have a sales compensation report coming out, and I was talking about it, and she's like, "How do I become the head of insights? Like, how do I get that title?" I'm just changing that title on my LinkedIn to head of insights. So thank you for that.
I mean, look, I'm trying to start a revolution here. Yeah.
You mean there's not like a head of insights meetup? You guys don't go to like your own conference on a quarterly basis?
Definitely can't tell you about that, AJ. That's a secret. That's a good thing. No, it's a great way to, as you all probably are more aware than me, like title inflation. Really good stuff, Head of Insights sounds great.
It really does. Well, we've got Peter Walker. He's the head of Insights at Carta. And Peter, thank you so much for joining us on short notice. I was looking at your bio, and I feel like you've been at Carta close to 3 years, but really feel like you're trained as a marketer. But I could be wrong.
Yes.
Originally. And you just wrote what blew the three of us away. Everybody's got to go read it. Let me figure out the exact title, but it's the State of Startup Compensation report that you just released for the first half of 2023. It came out on September 19th. And we wanted to bring you in to talk about it because it's I don't know if it's alarming. I don't know how you characterize alarming, foreboding. There's adjectives that you went to WashU, so you're smarter than us. So, probably you have better adjectives than we do, but just really interesting data. Why don't you, and Asad, why don't you kick it off? So typically Asad runs the docket. He sets the stage. So Asad, you brought it to our attention. Tell us a little bit about it, and then we'll get Peter to talk about it.
I think the place to start with the report is the fact that in the market, we've gone through a couple of really interesting years. As I was reflecting on this after reading the report, we've had the bust out of COVID where there were mass layoffs, millions of people lost their jobs. Immediately, there was this boom that happened, right? And in tech specifically, it was quite intense because there was this rise in digital transformation on the B2B tech side. There was a rise in the digitization of customer interactions on the B2C tech side. And then you had low interest rates. And so there was a boom there, tons of fundraising. And so lots of hiring happened over there as well. And then inflation became an issue and we again have a bust, right? So mass layoffs, et cetera. Yeah. So it was really interesting to see your report from a couple of different angles. And probably the best way to go through it is just go through the way that you guys have laid it out. And you started the report by talking about layoffs and the fact that layoffs are not rising, but they actually haven't subsided. There's still tens of thousands of people losing their jobs every single month right now. We all remember the start of the year because it was quite alarming and the numbers were large. But but January was 17,000 people, and we're still losing 10,000 people a month are losing their jobs. You showed that hiring has declined, voluntary departures have declined, and specifically hiring at the growth stage. And so talk to us a little bit as you looked at this data, what were you thinking when you saw it? And how does this make you think about the coming quarters and months? What do you think is going to happen there?
Yeah, it's, I think foreboding was a good word, Sam, here at the top, because
Sam's good words.
He's got great words, even if he didn't go to Wash U, which is fine. The thing about this data, so drawn from about 40,000 companies that use Carta as their cap table provider. And so that gives us really good access to labor market information on anyone who's receiving equity, because of course you have to be granted equity through our platform. And then when somebody leaves, either by choice or through layoff, you have to terminate that equity grant. So we know, and as you can imagine, boards and founders are pretty on the dot about terminating those grants. Those get terminated pretty quickly when someone leaves. So we have pretty good data on the labor market movement in that way. I think the biggest thing for me is that we all kind of lived through and read a ton of headlines about the spike in layoffs at the beginning of the pandemic, and then the great resignation period that followed, where tons of people were leaving their jobs by choice and layoffs were very low. And then those two lines sort of inverted in the beginning of, or throughout 2022 and then the beginning of 2023. So one, I do think that there's just this phenomenon where reporters just got tired of talking about layoffs as the headline again and again. It's like, I'm going to talk about this next layoff that was just a little bit less than the last layoff. Like, so it kind of fell out of the headlines a little bit, but it's still happening at quite a high pace. And then the other thing is startup employees internalized that. And they said, look, I understand the market. I'm not going to leave a job that maybe I don't love, but I don't hate it for something else right now. I'm going to stick with what I have. And that remaining in position, in seat, just like lowers the need to backfill. It actually changes the calculus on new hiring projections for companies. And it's sort of the underwritten part of this is that just people are sitting in seat longer than they were a couple of years ago. And so there's just, that has ripple effects through the available jobs in startups.
We were talking about this last week, actually. We were thinking, what would voluntary attrition look like next year? Because we are sitting at a time where people are not looking to move because there's not a lot of demand, but there's also a lot of risk when you move and they don't want to take on that risk. Do you see that number or the rate of people voluntarily leaving rising next year? And talk to us a little bit just generally about your view of next year, because there are kind of two schools of thought right now, right? There is the soft landing is happening, and so the market's going to improve, let's say second half of next year. And then there's this new narrative in the market, which is based on Jerome Powell's last statement, which is rates might go stay higher for longer, and we might actually do another raise this year. And so some people are thinking, well, all of next year is going to be a grind leading into the following year. How are you guys viewing the next year? And what do you think happens to voluntary attrition next year, depending on your view of the market?
Well, I think you touched on the thing that sometimes startup founders and prognosticators avoid talking about, which is just the outsized influence of interest rates on these companies. It's spoken about all the time with the broader economy, but it doesn't seem to be as much a thing in startup world, but it is. So that will have significant impacts on hiring plans and cash burn through 2024. If I had to make a guess right now, there's going to be sort of a bifurcated market, or it's going to feel very different depending on who you are. So I do think startup fundraising is going to increase in 2024. I think the worst part of startup fundraising was this quarter and last quarter. And we're going to continue. It might not get back to 2021 levels because those were absolutely crazy, but it'll continue to get more and more healthy in terms of the level of capital raised. Alongside that, though, more and more, and this is the dark part of the layoff story, which isn't in these charts yet, but it isn't just that people are getting laid off, it's that companies themselves are shutting down. So startups are shutting down at higher rates right now. We're preparing some data on that rate at the moment. But as a preview, Q3, we saw the most startups we have ever seen on Carta file for bankruptcy or go through dissolution.
Yeah.
Wow.
So that is
And
happening.
how many
and
is
I
that
think,
roughly of the 40,000? I
We're
mean,
getting
Um,
spoofs, yeah.
uh, I think in Q3. So to be clear, this is just companies that leave our platform for the stated reasons of bankruptcy or dissolution. So it's probably an undercount, but it is like it's the most tangible number we have. And it was 212 companies in
Wow.
Q3, up
Wow.
from 170 in Q2.
Wow.
So big jump. And I think Q3 will not be the worst of that, and Q4 will be worse. So
That's
story
based on instinct. What do you when you say the Q3 won't be the worst of it? Is it just?
it's just that it's basically increased month over month. So I don't know
I mean,
why.
there's probably
September.
some relationship between like number of employees correlated against funding rounds or total capital
Yes.
raise, where you can sort of infer, hey, there's not enough money going into these companies to support them unless you're wildly wrong about their burn rate. Then by
Yeah.
definition, there's a physics involved in terms of like just those ratios.
Yeah, you
First
could
of all-
definitely see a way to do like like a warning index where you say,
Yeah.
hey, this company is this far away from their prior raise and has this sort of profile, like heads up. Yeah.
It's, I mean, it's sort of occurring to me as I'm looking, and I was just looking at some of the other research reports that you've written. You all sit on the most fascinating data set in the entire startup ecosystem. You have a great job. This is fascinating.
That's why I get this title inflation. They're just like, look, we're giving you the data set. Like here, you have.
Well, they didn't give you the VP title yet. It's just
not yet.
It's just head of insight.
I mean,
After this
sorry, I didn't hear that.
podcast.
Say that again. What was it?
you should be promoted. Tell Henry. To be promoted.
Interesting. Yeah.
Peter, one of the more interesting stats that was in it that I think when I shared with my team, they immediately shared back was the tenureship.
Yeah.
Yeah.
That was one that was kind of like an eye popping, like, wow, but I don't without context, I was just wondering 2 years, is that the lowest it's ever been? Or did we see cycles back previously that was actually, no, 1.5 years and it's actually increasing? It was tough to tell.
It's a little tough to tell on account of the layoffs. So one of the things that I think you mentioned earlier, which was a very good point, is that part of the reason why people are voluntarily leaving their positions less frequently is this sense that, which is true based on our data, layoffs happen to more junior and less tenured employees more frequently. So if you've been at a company for 6 months, you are more likely to be laid off in a layoff than someone who's been there for 4 years. So I think that's, if it's not conscious, then it's a little bit like in the bloodstream of the startup marketplace at the moment.
Quite
in terms
conscious.
of tenure.
So just from our point of view on the market, as recruiters, a lot of the people that we engage for positions, when they decide not to engage on that position, they're specifically saying this. They're like, listen, this is interesting and I'm ready for a next step, but I have a young family and I can't take on the risk of moving. And the risk associated with moving, they speak to 2 or 3 things when they speak to it. The first is, if I move, I need to learn about this organization, adjust to its culture. Like there's always risk associated with that. Here, I know I'm secure. Over there, I'm taking a leap of faith that this will work. And the second one is, there's this information asymmetry when you are speaking to a new organization, right? About joining. There's information that, we were talking about this a few weeks ago, that there's so many CROs that don't know how much cash is left in that organization. So for a new person, there's a lot of blind spots. And so they're like, what if this company is in a bad spot? And they have to do another round of layoffs. Then last in, first out. And I don't want to be impacted like that. So you are right in what you're saying. We're hearing about this all the time.
Yeah. And so getting back, that's a great point. And it kind of relates to the tenure sort of graphic that we have, which is, people can't see it on the pod, but there's, basically something like 50% or more of employees at a given startup, all the way from, startups worth $10 million to unicorn startups worth $1 billion. Less than 50% of employees have been there for more than 2 years. That's fairly stable. Maybe it's a little bit higher than it used to be, but it's fairly stable if you were to go back a couple of years. I just found it fascinating because it has a lot of implications for the way that startups use equity.
Yep.
And this standard sort of compensation agreement that everyone has sort of come to an accord on, which is 4 years of a vesting period and then a 1-year cliff. Well, there's a lot of employees that won't make it to those 4 years. And then they have to choose whether or not to exercise those vested stock options. And, the other part from this report that was pretty eye popping was just fewer and fewer of those employees are exercising their options. Now that's not to say they're like missing out on upside. Probably that's the right financial decision for them because their company isn't doing so hot and maybe they just got laid off. And are you going to really spend $3,000 to exercise some stock from this company that just laid you off that isn't doing well in the first place? That's a difficult position, but it does get back to the root thing, which is startups. And aside to your point, like startups are at an information advantage to their employees when they're joining. And one of the things that they talk about a lot is the value of that equity. And right now, employees are voting with their dollars that they don't agree that equity is worth what they're being sold is worth. Yeah.
And I think that's what hit us like the hardest as we think about our conversations, as we talk about morale of the organization and people that are engaged and leaning in. Equity is absolutely a leading indicator of that, both on the exercise and on the front end and what they're talking about. If they're coming in and they don't really trust the value of it, we had the conversation last week where we're seeing companies that are up down rounds that the common's being repriced, but then it's 2x participating or 3x participating. So like you're underwater at that point, and employees don't understand that. They don't know that was part of a term. And so when they see, a $200, $300 million exit in 2-3 years, and are like, oh, great, we raised it at $100 million valuation, but the preferred stack just takes most of it. They're going to feel that. And then they're just going to feel like they're getting burned from startups. And that's what I think is a lot of this is happening, is like the preemptive of feeling like you're going to get burned from a startup equity, from an equity perspective.
I totally agree. There's a ton of employees that are not asking the question, hey, what about the liquidity preference? What about the participating preferred on these new deals? Like, it may be pitched to them as we're repricing your shares so you continue to have upside in our business, not we're repricing your shares and doing all this other stuff that really makes that repricing essentially immaterial to you. That's not, I haven't heard very many founders get in that in depth with their employees that way.
I thought one of the interesting things, Peter, I was looking at net headcount, and I was trying to see if you wrote growth, but it wasn't growth. It was net headcount. So over the last, with January being the exception, the industry has contracted meaningfully.
Yes.
I mean, I guess that's what layoffs mean, but this is a smaller industry than it was. And I guess I have one observation and then one question, which is, one observation is I just feel like what's happening to the point. I figured out the right word. It's not foreboding. It's sobering. Sobering was
sobering.
I'm very sober
which
now.
Implies that we were drunk the 2 years before.
Absolutely, we were. Well,
exactly.
There's Fred Wilson always talks about this idea that like there's only a set. Not just Fred. I mean, David Sachs, he called it craft ventures for a reason, which is that like this is an artisanal business. This is a boutique business. It doesn't scale. Mm-hmm. The fact that Fidelity or Tiger Global or any of these firms were in this business in the first place is maybe misplaced, and that there's only a certain number of good companies that can be created in any given time. And maybe there was just a mismatch between capital and the availability of good ideas. And so one part of me just thinks this is a fundamental recalibration. I mean, we talk about it almost every week on the show, which is like we're going through a period where everything that we understood or that other people understood to be true over really the last 15 years in the period of low interest rates is being upended. And that's seismic because it's the go-to-market motion. It's the viability of the SDR as a cost-efficient investment in demand generation, which effectively is a function of low interest rates. So one part of me is just like, hey, we're contracting. Maybe we're contracting to whatever the right size industry is at 5.5% Fed funds rate. And then the other part of me is saying, but on the other hand, I've been around the country on this Road to Nashville tour for this conference we're doing in 2 weeks, and there's more entrepreneurs and solopreneurs that I'm meeting today than there ever has been in the last couple of years. And I wonder if you see new company creation or new company starts in Carta. Now, some of them I think are probably LLCs. They might not need Carta to manage their cap table, but I'm wondering if you see green shoots on the other side, maybe because of generative AI or other things that are giving us some cause for believing that, there's some economic growth indicators, even if our companies are not optimally designed to take advantage of them, there's optimism for the human race as a whole.
Yeah. And side pitch. We do actually help LLCs manage equity if they give equity out to their employees. So that's awesome. But to the overall point, I think yes, the way that we have, or the way that I've been speaking about it a little bit internally, is that it's a very difficult time to be running a business, but it's a wonderful time to start one. And for a whole host of reasons, Gen AI and all of that probably in the future means that you're going to need less headcount per unit of revenue, et cetera, et cetera. These businesses are going to be capital efficient. They're growing up at a difficult time. Actually, Namdi Irregulum at Lightspeed, I believe, has some great long substacks on how even if you actually break out the level of innovation, we haven't been creating that many more new companies that are venture backable than we used to. To the David Sachs point of there's only so many venture backable ideas in any one time. But new companies, Carta, it used to be that Carta was the kind of place that you joined when you were raising a seed round or maybe even a Series A when you kind of got real serious about it. Now, thanks to our Carta launch program, which is totally free, companies join us when they're just ideas, even before they incorporate sometimes. So we are seeing an explosion of new company ideas. And the way that I kind of think about it is it's sort of a Shopify model where, we just want everyone to start. And there's going to be a lot of people who start and that idea doesn't go anywhere and you can't get funding and all that kind of stuff, but at least they started with us. And so we're seeing an increase in that for sure right now. That's a bit of a cold comfort for if you're trying to raise a Series B and nobody wants to talk to you though.
Sam, we went through some Yelp data a little while ago as well that showed that there was a significant increase in the number of new businesses that are starting. It traditionally happens whenever there's a downturn, right? Because people are getting laid off and then they're sitting and thinking, what should I do next? Do I go look for a job or do I try something on my own? So that entrepreneurial spirit you might have more reasons to lean into it because that security of your last job is gone. The second element is also that there's some interesting things happening like AI, and AI itself creates opportunities for people to create AI businesses, but it also creates opportunities for non-technical people to be able to create a business in a way that they couldn't before. So there's that increase over there. The thing that about this, the month-over-month decline in net employees that stood out to me was that I don't know if we'll even see an increase in next year over here. Like we might see many months where it continues declining because there's also this push towards efficiency and we have new technology that's driving productivity increases that are really substantial. Like the co-pilots that are there right now and they're version 1, right? Like we'll have autonomous agents and all these other things. But even right now, there's viable technology that's making people 50% more productive. Next year, it might become 100% more productive. So companies might just not need a lot of people or the amount of people they needed before. So it raises the question, like, what happens to those people that aren't going to be left on the sidelines? What do they end up doing? But yeah, I don't think a Series A company will have the same amount of employees in next year and the year after as they've had to have before.
Yeah, I agree with that. And I think that there's that sort of structural shift. Some of the impacts are starting to be felt there. But if this continues into 2024 and it's just that the median employee count at a startup goes down by 20% permanently, what does that mean for the industry? I think is a really big question, especially since there is the pressure from those that want to go public. So obviously, across the startup world, there are far more employees who work for startups like Carta, which is Series G or super late stage, versus your average seed stage or Series A company. So the decisions that late stage private companies make in order to prepare themselves for the public markets over the last year has been cost reductions in many, many, many different ways. And now that IPOs are back on the table, knock on wood, for a while, it'll be interesting to see if the market keeps rewarding that sort of efficiency to a high degree and a little bit less on growth, then companies are going to take that cue. And you have to look at this hiring graph as, I'm a little bit more optimistic. I think we'll probably turn positive, but I don't think we'll get back to the same level of growth that we were in the prior couple of years.
Well, Peter, I think you mentioned the very beginning of this, probably the most interesting, the crux of this is the interest rates and how do startups talk about interest rates. So like, I'd ask you, like, how should we as founders, CEOs be talking to our teams or how do you think we should be talking to our teams about those? Asking you to forecast that out. But yeah, I'd love to know from your point of view of like what's the conversation look like?
Point them to who's it on Twitter? Kayla Scanlon, I think, does a fantastic job of meme videos about interest rates. But honestly, I just think that on the founder side, at least when it comes to the compensation and like hiring plans for your company and all that kind of stuff, communicating that sort of things back to the employees is crucial. And if you're not including the macroeconomic context, then it kind of feels like a big portion of the puzzle is missing. So it's not just that venture capitalists have become focused on efficiency when before they would grow at all costs. And it's not just that our competitive set is getting higher or that valuations were far too high 2 years ago. It's also that just like the cost of money has increased. And we have to be in some way or shape or form responsive because we're going to get pressure from our next round of investors to be responsive to these sorts of things. I think that startup employees get that. They're not dumb by any means. They are very, very conscious of what's going on in the news. What might not be clear is the direct connection between those sorts of macroeconomic things and what they're seeing in their compensation or what they're seeing in their growth prospects at a given company. So, like I said, the advantage if you're really small right now is that you are growing up in this environment and you don't have to do that sort of explaining. Whereas if you're Series B trying to raise Series C, we've seen down round, like 20% of the rounds on Carta right now are down rounds because things just got overvalued. And that's almost as though the correction from one state to another is much harder than just being in the second state to begin with.
Peter, how is that
100%.
20% compared to historically? In a stable market, what percent of companies do down rounds?
In a stable market, it's about 7 or 8%.
Wow.
Do
So
you think
almost
that
like
number will increase? Do you think that number increases? 20% goes quite a bit higher?
I don't think so. I think the dark side of that 20% is the ones that can't make it and are shutting down, right? Because the down round is the last thing you try before everything.
When you say like 200 or however many that are shutting down, I think of like two line items on the cap table on Carta. I mean, we're not talking growth equity companies that are like, you guys have 100, 150 shareholders on these tables. Those aren't shutting down yet, right? Like that's.
Oh, no, they definitely are.
Oh, really?
If I break it out by series A, I mean, so if you're talking about like Series C and beyond, it's still very small numbers every quarter.
Sure.
But if you take Series A, it's like, in 2021 in a given quarter, like 8 or 9 Series A companies shut down that year. This year, this past quarter, 30 Series A companies shut down on Carta. Wow. So like it is happening to people who have raised significant VC cash and then are just not. It gets back to that down round question. What we've seen is if you can't raise a primary, try to raise a bridge. If you can't raise a bridge, try to raise on convertibles like safes or convertible notes. If you can't raise that, talk to someone about a down round. And if you can't raise a down round, then you have.
There's also the soft landing in an acqui-hire situation. So these are just these are bankruptcies. Those aren't even soft landings.
Yeah. Not soft landings. So that was my hypothesis coming into the year, was that we would see a lot of acquisitive behavior, people snapping up startups at really, really low valuations. Acquisitions have, they're still happening. It's 140, 150 companies on Carta get acquired every quarter. But it hasn't grown at all. It's basically flat from where it was last year. So
that tells me that it's almost like a secular. There's not like this bifurcation of like it's good companies versus bad companies. Because if it was, then you'd see that the companies with leverage or strength become leaning in, presumably because they had more access to capital.
100%. Yeah, it's just not really. I mean, it feels weird to say it's not the individual companies, but it really isn't. It's like the season has just changed on everyone.
Peter, is the opportunity where there's a lot of pain as well? So you mentioned that Series A is where a lot of the shutdowns are happening. But the other thing that was fascinating is when you look at the venture funding data, earlier stage companies have been relatively more secure than late stage companies in terms of their ability to raise money. And generally, that seed to Series A moment is quite an important moment because you're going from having proven product market fit, hopefully, to now growing and trying to prove go to market fit. So you actually have to build out certain teams. And so I would assume that the hiring data, there's a difference between growth stage and then this type of a company where there might be more jobs for people at Series A companies right now than there are at your Series C, D, and E stage companies who really don't have much reason to go and hire right now. How does that as a statement sound? Does that sound accurate?
It does sound accurate, but with the only caveat being you need a lot more Series A companies. You know, even a Series A company who's quote unquote hiring quite well may only have 4 or 5 positions open at any one time because it's just a smaller, it's a smaller business overall. So versus a Series D company, which might have 25, 40 positions open, even if they've reduced hiring for the year. So the scale really changes, and some of these late stage startups are quite large. You know, Carta at this point is 2,000 employees. So that's, that's at least 100 Series A startups to like match the employee count. So yes, to your overall point though, I do think that there is more opportunity at the earlier stages. Fundraising has held up much better at seed and Series A than it has in later stages of venture. So it's sort of again a bifurcation. But if you're a great salesperson that's used to selling at a Series C or Series D startup, that jump to Series A is a risk, no matter what company it is.
I was talking to a friend of mine last night, Kyle Norton, who is the SVP of revenue at Owner, which maybe is a Carta customer as well. He found your report really insightful and interesting. And the conversation we were having was, if compensation increased quite significantly when the market was hot because the demand for talent greatly outweighed the supply of talent in tech, and since you can't increase the supply of talent easily, price goes up, so compensation went up, then how come it hasn't come down now? Is it that compensation is one of those things that are inelastic, or is there any other reason?
I think on the salary side, it has to do a lot with the inelasticity of comp in general. It is very difficult to go to an employee and reduce their salary. That doesn't happen that frequently. Yeah, wages are certainly sticky. However, as the report showed, we are not seeing that same dynamic in equity. Equity packages are falling quite significantly across seniority levels, across roles, less for C-suite people, of course, and less for engineers than for some other functions, but still like declines across the board. And I think part of that is just, when you walk into a candidate walks into a job interview, they may have pretty set expectations about salary, but you give them an equity figure and it's kind of tough to know, hey, is this low, high? They're not walking in with a lot of priors in that sense. So it's easier to adjust it downward. And then the other reason that companies are doing this is just that because of the fundraising being extended out further than they expected, they have to make their option pool last longer. And so each next hire gets percentage-wise less of the option pool because they expected to have refilled it by now, but they can't because they haven't raised.
Is that equity benchmark, though, being driven by company behavior or by candidate behavior? Because on our side, something we found really interesting was when the market was hot, you would hear about these people that had some outcomes, right? Really exciting outcomes. And so it created this energy in the ecosystem where people were trying to optimize for ownership. And so there were people that were saying, I'll actually take less than the top end of the cash component for this job, salary and variable, but I want more equity. And then obviously, even in the good times, a small portion of people that get equity really have life-changing outcomes or any form of outcomes because of it. But probably the ones that got it in 2020, 2021, 98%, 95% of them are sitting on something that's worthless. And so what we've seen is a shift where they've been burned. The economy has changed. They're optimizing for stability and risk management. And so they're saying, I actually care less about equity. And these are VPs of sales and CROs. They're saying, I want a salary that is solid. I want a total income that is competitive and is achievable. And they are spending way more time on the achievability of that total income than they are on the equity portion. So that makes me think that this equity benchmark decline is candidate driven a lot more, because when we speak to companies, they're trying to give equity to get discounts on cash because they're trying to preserve cash. How do you think about that?
I think that's a completely valid theory, and most likely more applicable the more senior you are. But for the rank and file employees, my guess is that companies are not really budging that much on the salary offer. To be clear, the salaries haven't really declined that much, right? They've sort of plateaued. So I don't think that we can say, hey, employees are getting a raw deal on salary. Maybe they're not getting as much as they possibly could, but it's not bad. But like when we talk to candidates that are not on the C-suite or VP level, it's basically like, look, I've been trying to get a job. I have one offer. I don't have a lot of negotiating leverage. I'm not going to come back to that company and start to negotiate really hard as though it's 2021 and I have two companies waiting in the wings. I think you're right about the idea that this is partly candidate driven, but I would still say it's more on the company side.
I feel like we're, again, just coming back to the recalibration point. I think your report calls out, I'm curious what everybody thinks about this, but I wonder if we are not, well, maybe the four of us on this call appreciate it, but I wonder if the world appreciates that I've been on this tour and I'm with this guy, Jocko van der Kooi, who runs Winning by Design. And he keeps talking about how we're in a phase shift. And I wonder if we're not appreciating the fundamental transformation that is happening right now. And a couple thoughts that I would love your reaction to. The first is, you're not going to see a downward shift in wages for people that don't show up on the cap table at all. And because I know a lot of companies that are they're not necessarily looking at replacing a VP with a VP. The first thing they might be doing is looking to replace a VP with a director. If they come in as a director, I don't know if I'm understanding your data set the right way, but I wonder if that wouldn't be apples to apples, and so you would miss that as a downward movement on wages. And the other thing I'm seeing is just a lot of people saying, I mean, literally, I was at a dinner last night, and the guy is starting a recruiting firm to focus on offshore talent, but higher caliber offshore talent. So director level product management, director level sales management, but from places like Turkey and Pakistan and Nepal. Customer support, not just from the Philippines, but from Nepal. So again, sort of to the point of like this net headcount growth, I wonder, at the same time that we're seeing these shrinking company sizes, we're also seeing this compression of valuations around the business model of SaaS, not just startups specifically, but I think fundamentally B2B SaaS is being called into question because Gen AI is much less reliant on a seat-based pricing model. And so even if you see capital formation around generative AI, it might not have this sort of 10x recurring revenue dynamics. There's a guy, the former chief customer officer of New Relic, who's in my LinkedIn messages right now, telling me he thinks even subscriptions are not customer centric enough, and that really all future pricing models should just be completely usage based with no platform fee. And so I don't know if you guys agree with me. I just feel like this is a fundamental. I always talked about, and we talked about this a couple of weeks ago with Mark Roberge, that it's like, when will the market come back? And founders holding out for saying, you know what, I'm going to wait this out. And it's like, but the market is dynamic. It's not just interest rates. You can have lower interest rates, but the dynamics of how businesses are structured might have shifted away. And I think the people that are hurt the most are employees. I think founders have a lot more tools at their disposal to navigate this. But I think to your point, there's just a lot of what we've all just said, but especially Peter and Asad have just said is, hey, equity doesn't mean shit to me anymore. So it's like, okay, well, that was a pretty fundamental part of the whole damn equation,
Right.
So I don't know. It just feels like this is a pretty kind of like pivotal moment, and this is a phase shift, as Jocko said. I don't know if you guys agree, but that's what the data is telling me. Things are very different than they were.
I'm interested in what you think, Asad and AJ, but the one piece I wanted to pick up on there, Sam, was when you're talking about offshoring to high quality locations or higher quality employees than perhaps you would have expected from those other locations. we do see a slight trend towards certainly both remote work and then international remote work as a separate topic. We've broken out sort of the compensation, not in this report, but I think in the prior one, we did a lot of data analysis on, how should you expect your base salary to change if you're in New York versus Switzerland versus Australia, et cetera. Those things are real. That arbitrage is certainly available to companies. There's hurdles you have to jump through. It's like it's a bigger deal to hire from Argentina than it is to hire down the street in many cases. But I'm not surprised that you'd hear more companies turning to that as an option. And then just generally speaking, I completely, this could be a sea change in how startups and small businesses and tech work in general. And there doesn't have to be some date at which we return to what we came from, or it could just be allostasis and we're just in this new normal forever, or whatever that new normal becomes.
Yeah, well, the interesting piece here, and this really hits Peter on the head with Carta, is this idea of ownership, right? Henry's talked about this over and over and over again the last 15 years of just ownership, making everyone shareholders, stakeholders. And I think I remember him talking about this point of view, this lens where an employee leaves an organization. Do we send a notification that they can exercise? They have this 3-month window when they had early customers saying at eShares, like, hey, I don't turn this off. I don't want this. And had to make a choice at that moment in time, whether they're like, okay, we'll listen to a customer, or like, no, this is our whole mission and vision of like where we're headed is this idea of ownership. And here we are having this conversation around equity and ownership changing, and just the balance just changing and shifting. So I'm sure Carta, just like the rest of us, is kind of in a wait and see mode. But has anything shifted internally, or from what you've seen on Carta's perspective on this idea of ownership?
That's a great question. By the way, we send that email, just to be clear.
No, you do. I know you do.
I think we send multiple emails. Yeah.
Yes.
To your point, though, so fundamentally, no. I think that the point of Carta's existence is to create more owners, and we are super focused on the idea that ownership, like moving employees from the debt stack to an ownership stack, equity stack, matters a lot. The changes might be more in the way that equity is delivered, or the way that founders and employees work together to understand that equity. So this kind of gets into some of the later parts of the report, where you have things like, you spoke about the 90-day window. Why is it that an employee has 90 days, no matter how long they've stayed at the company, generally speaking, to exercise their remaining vested options, or they return to the pool? It's mostly just a quirk of the tax code, right? There's the difference between an ISO and an NSO. There doesn't have to be, Amplitude has a 10-year exercise window. Why not? There's at Carta, our exercise window is tied to our length of employment. It rises as we become more senior in the organization. Why not? There's a lot of experimentation. I would expect people to start experimenting with the actual format of equity in the future. So things like your vesting schedules, your option windows. We've all seen that OpenAI doesn't actually do equity the way that other companies do. They have profit participation shares that are pretty cool. Like, I don't think that we're getting away from the broad concept of having employees own a stake in what they worked for. We may be at the end of a period in which everyone is 4-year vest, 1-year cliff, and we just kind of follow the routine.
Yeah. By the way, hilariously, we have a shared, Carta and QuotaPath have a shared investor in Tribe Capital. But the really funny thing is, when we went to change our window, it was like at the board level, very negatively viewed. But then we pulled the Carta report up like multiple times of like, why does this matter? It doesn't matter to fight against it. So I think there's just like an investor fight against it, which they're usually founders and investors are they're aligned on that. Sometimes it depends on the founder for sure. I think the 4 of us here can all say like, hey, we want our employees to partake in the ownership. Not all founders are created equal there. So it's just kind of fascinating.
I don't know about that.
Yeah. Okay. I'm on the level. Some of us are aligned on it.
Any particular employees you'd like to call out? The floor is yours.
That's awesome.
I think, Sam, to your point on that reset, I've been thinking about this a bit. And I feel like it's even bigger than a reset. Like a reset would be if we got frothy, interest rates went up, and we're kind of falling to the equilibrium. I think the fact that there's AI and its implications on pricing and average number of employees per company per stage, it's kind of like the sector's been reborn completely with just a new point of view on how much money it takes to build a company, what type of companies are buildable, how many people you need in those organizations, how do you incentivize them. So I think the word reborn feels like more appropriate here for me. And then on this ownership side of things, I think the model that's in place right now only works when the market's really, really hot and interest rates are really, really low. And so I think we're not going to be in that type of a market for a while, right? Like interest rates might go down. They're not going down to 1% and 0% for a while now. And I think, Peter, your point is correct, where there might have to be a rethinking around what exercise windows look like, vesting schedules look like, etc. Do you see companies starting to lean into this already? Or is this something you see needs to happen, but it hasn't begun happening?
There's definitely companies experimenting on the margins. I would say it's at the very, very early adopter stage of, minor single digit percentages of companies doing something different with vesting schedules. We've seen some of the more interesting stuff is, companies that are not going with the standard vest of 25% per year for 4 years, but rather they're front loading or back loading that vesting. There's different ideas around exercise windows, obviously, which, and to the point, it is kind of funny, exercise windows are 90 days basically for everyone until there are layoffs. And then some founders find it in themselves to give people far more than 90 days, not a lot, but it jumps from like the percentage that have more than 90 days jumps from 10 to 20 when there are layoffs because they feel awful, but it's like, okay, well, you could, that's a structural thing that you could do at any time. The other point about equity and the value of ownership, which I think we haven't spoken about yet, but obviously Carta is invested in, is it's obviously not just about ownership, it's also about liquidity. How quickly can you realize actual value from your equity? Used to be it's IPO or bust. In the boom time, we did see a ton of secondary activity, mostly between founders and investors. But is there a way that you can systematically bring employees into an earlier liquidity state such that they can share some perhaps of that secondary transaction activity? Carta has a liquidity business. It's not like it's not Charles Schwab. You can't go on and just trade stocks there. But over the long term, like how do you enable different forms of liquidity for employees? I think it's the other missing piece of the puzzle around what ownership actually means.
Because in the past, there was yearly liquidity in or form of it, right? Like, because in the past, let's say you were at a law firm, you became a partner and you got equity, you would get dividends. Like every single year you would get dividends. And then maybe there would be this larger event where you would get the value for the equity in a different way. It would be a bigger amount of value. But there were yearly dividends that were baked into the model, which has been the predominant model for 100 plus years. And this way of doing it that's specific to tech and a very specific form of tech companies is very new, and this is a big issue with it.
Yeah, and I also think I think to your point, Asad, that's why people are starting their own companies.
Yeah,
because it's like, well, the wealth creation opportunity for owning out of the money options that expire after 90 days with 2x liquidation preferences sitting on top of it is very different than, well, I can deduct my rent, I can deduct my dinner, I start my own LLC, my own sales training business or something. And we talked about this, last week or a couple of weeks ago, but fundamentally, the only thing I've realized after doing this for 25 years is one way or the other, the only way to get rich is to own something. And if the equity that you own in your startup is not going to be worth anything, then you might as well own 100% of your own venture.
Yeah.
Sold. The other part to that too is like when you look at we have a growing business where we manage the equity for LLCs. A lot of the LLCs that give equity to employees are backed by private equity firms, and the model there is just so different because a private equity firm is typically a 3 to 5 year stint, and then it gets sold again. And at that sale, there's a liquidity event. Whereas part of the problem with startup equity as it relates to employee actually realizing any value. It's just that startups are staying private so much longer than they used to,
Yeah.
It's like it's a decade or more as a private company. Whereas if you had, you joined Facebook back in the beginning of Facebook, they IPO'd after what, 7-8 years.
Well, it's interesting to say that because my first company, after 7 years, the early stage funds, there was definitely a downward pressure for liquidity. We felt that. So that 7-year number was a very real number for us. But I look at us, we're at QuotaPath at 6 years. We're talking like, okay, the next like 4 or 5 years from now, even with the early stage, it's like everyone's kind of adjusted and that shift has happened with our companies. But like in that context, are we thinking about our employees' motivation and their morale to be able to do that? Because it's been really tough. Like the three of us will say very clearly that this year has been probably our toughest years in our career. Our employees feel that. It feels like we're working harder for less. And like, how long is that sustainable as well in this like bigger compensation conversation that we're having?
Yes.
It's tough.
Totally. Yeah. And then people start looking elsewhere from private tech, right?
Right.
Those skills are transferable to other parts of the economy that
they're
perhaps,
tech. Yeah.
The upside isn't maybe quite as high, but the floor is much higher. So
yeah, well, you have the energy and pharma. Like I found that part of the report pretty fascinating, and like the remote versus in person and energy and pharma and then different cities. That was a great part of it as well.
Yeah.
Peter, we unfortunately we have to. It's been an incredible conversation. We really appreciate you doing this on such short notice, but we have to say goodbye to you because we have one more segment to record before the top of the hour.
Well, there we go.
You need to come back. We'd love to have you back often.
And you're not allowed to be a part of it, apparently, says Sam.
I guess I won't even know what the segment is. It's very creativity here.
It's he can join if he wants. I'm okay with it.
Actually, let's do it.
That's great.
All right, cool. It's called Topline Hotline. We'll have you do it.
All right.
So this is coming out on Monday. I think it's October 1st. Or what is it? Is it October 1st? Is next Monday October 1st? Crazy. Anyway.
The
second.
Okay, the second. So you're listening to this on October 2nd. Thanks everybody for listening. On behalf of myself, Sam Jacobs, CEO Pavilion, AJ Bruno, CEO QuotaPath, Asad Zaman, CEO of Sales Talent Agency, Peter Walker, Head of Insights, SVP of Insights and Global Revenue.
Chief Insights Officer.
So strong. We got a skip level joke there. That's pretty sweet.
You're welcome. You're welcome, goddammit. Thanks for listening, everybody, and join us on Thursday for Topline Hotline. This episode was brought to you by Close, which helps organizations improve their sales win rates, build better products, and consistently uncover the real reasons they win and lose business. Visit freebuyerinterview.com to learn more. Closed, freebuyerinterview.com to learn more. Win-loss analysis is incredibly important. So thank you for listening, and thanks to Closed for sponsoring the show.
Thank you for listening to this episode of Topline. To learn more about the trends, news, and developments impacting the world of B2B SaaS, head to joinpavilion.com, where more than 10,000 of the world's top go-to market leaders go to achieve and unlock their full professional potential.